So you're ready to buy a house and you don't know where to start when it comes to paying off debt or just going forward and buying that property. And everybody has an opinion. But guess what? I'm going to tell you exactly what you need to do first before you buy a home. So you have debt, just like most people do, whether it's student loans, credit cards, car payments, really anything that would report on your credit report is going to be considered debt for the purpose of obtaining a mortgage. So what do you do if you think you have too much debt to qualify? Well, don't just make that assumption. You're going to want to speak to a lender to find out exactly what you qualify for with your debt included before you start paying things off. So let me show you what lenders are actually looking at when you're getting qualified for a mortgage. And believe it or not, it's not your balances on your debt, it's the monthly payments. So don't get carried away, don't move too fast, don't start paying those debts off until you have the conversation. Let me show you how this works. So if you're like most people, as I said, you probably have some debt on your credit report. I'm gonna show you the most common types of debt that would be on your credit report. So naturally, you can have credit cards if you use those on a monthly basis. This is called revolving debt. You might have an auto loan, meaning a loan for an automobile. You might have an auto lease, right? You're not buying the car, you're leasing the car. You might have some student loans and you might have some personal loans. Personal loans are going to be maybe a loan you just took out from the bank, maybe used to pay off debt. Could have been for anything. Used to purchase a ring for your fiance, whatever it is. That's a personal loan. So these are the most common types of debt that we see on someone's credit report. And you can probably relate, right? Some of these things are probably on your own credit report. Now, let's just say you had credit cards and the balances on these credit cards were $20,000. And then you had an auto loan and the balance on that auto loan was $40,000. You had an auto lease. The balance on your auto lease was $15,000. You have student loans. The balance on those were $100,000. Personal loans, you have another $12,000. Now, you might look at this, or someone who's never been through the process or isn't familiar with the mortgage process, and say to themselves, man, okay, I have $200,000 in existing debt, and now I'm going to go try to buy a property for $500,000. There's no chance a mortgage company, a lender, is going to give me a mortgage for that money. But believe it or not, they actually will, assuming that your debt to income ratio, which is your DTI, can support it. Now, what is your DTI? Your debt to income ratio is a comparison between your income and your debt, right? So we said these are your debts. The income that it's referencing is your gross monthly income, meaning your monthly income before taxes are subtracted. A lot of people are surprised by that because we know that's not what your take-home pay is, which is your net income, but lenders actually go off of your gross monthly income. So the amount of income you receive before any deductions are removed. So if you have a salary of $100,000, we use your salary of $100,000, so on and so forth. So that's what lenders are looking at. But it's a comparison between the two. So there are certain thresholds that we need to stay around depending on the type of mortgage that you're receiving. So I'm going to give you some examples of that. So let's just say you're looking at a conventional mortgage. The maximum debt to income ratio is 50%. If it's an FHA mortgage, you have two different ratios that lenders are going to look at. They're 47 and 57 maximum. What this first number represents is the maximum housing expense ratio, meaning what the payment on the property that you're trying to qualify for is compared to your gross monthly income. What this 57% represents are your total debt. That means it's this housing payment plus any other debt that you have, right? So they're a little bit higher, as you notice. 57% is higher than 50%. So what's nice about an FHA loan is that if you have a substantial amount of debt outside of your housing payment or proposed housing payment, you have a little more flexibility because you go to a higher debt to income ratio. Well, let me get back to where we were talking, right? We were talking about your monthly expenses, not just the balances, right? So we know what all the balances are on these, but what's most important to us as lenders to figure out your debt to income ratio is not the balance necessarily. It's what your payment is on these debts. So we see you have credit cards of $20,000. So I'm going to bring this down here. So we have credit cards of $20,000, but on this $20,000, your minimum monthly payments might be $300. You have an auto loan. Your auto loan's $40,000, let's call it, but your monthly payment is $500. So you need an auto lease instead of an auto loan. You could have both technically on your credit report, but let's just say it's one or the other, $15,000, but your payment on your lease is $300 a month. You have student loans. We said that's $100,000. Well, maybe you're on an income-driven repayment plan with the student loan company, and maybe your monthly payment on your student loans is only $50. And then you have personal loans. We said that's $12,000, and maybe your payment's only $100 a month on that. So rather than looking at this collective figure, right? Which is near $200,000. It's a big number. And you might say, as I've already said, like there's no chance I'm getting a loan. Well, that's not what we're looking at. We're looking at these numbers. So what do we have? We have 300, 500, that's 800. Another 300 is 1100. $50, 1150, $1,250. So this is what we show as monthly expenses prior to adding a housing payment in. So now what we need to say is, okay, how much money do I make on a monthly basis? So let's keep it simple. So let's just say you have a salary of $120,000 a year. $120,000 a year divided by 12 months in a year would equal $10,000 of monthly income. That's the number we're going to work off of. So now we have $10,000 per month of income. Let's just say we want to go with a conventional loan in this case. So we said we go to a 50%, 50% debt to income ratio. So 50% of something is half of something, right? Just to keep it simple. So that would mean we have to take our monthly income, divide it by 2. That's going to tell us what half of that number is. And that's going to give us $5,000. What this number represents is what our total monthly debt can be, including the new property you're wanting to buy and your existing expenses. So now let's figure out how much you can actually pay for a property on a monthly basis. So all we need to do to figure out that math is take the 5,000. I'm going to come over here. So we take your monthly income at 50% DTI. That's our $5,000, right? Technically half of your total monthly income. From there, we're going to subtract $1,250 because we said that's what your current monthly expenses are. It gives us $3,750 per month. This can go toward your house. So you might have said, man, I have $200,000 in debt. There is zero chance I'm going to be able to buy a property. And surprisingly, we ran the numbers. We used the minimum payments that report to credit. And it told us that you actually can buy a property as long as that monthly payment based on $120,000 of monthly or of annual income, $10,000 of monthly income, as long as that payment's $3,750 per month or less. Now, there are ways to push this debt ratio down even further. Give you just a quick example. For the student loans, there are people that are on income-based repayment plans of $0. If this payment was 0 instead of 50, this would be reduced to $1,200, and this would increase by $50, meaning we'd be at $3,800 per month, right? If this auto loan, not the auto lease, for example, if it had less than 10 payments remaining, so we said the payment's $500. If the balance was, call it $5,000 instead of $40,000, $500 into $5,000 is 10. We wouldn't even have to count this payment at all if we're doing a conventional loan. That would free up another $500 that can go towards your housing payment. And now you'd be at $4,300 per month. So the point being is if you have monthly debt or you have a large amount of debt on your credit, not say monthly, you're not really concerned with that, right? You're focused on what your balances are. Don't let that confuse you. Don't let that scare you, make you think you can't buy a property. Once again, like I said early on, have a conversation with a lender, have them walk through your scenario with you so you can figure out whether or not you're in a position now to buy rather than going and paying off all your debt first, because we know that could take years to do. And by taking years to pay off your debt, although that's great to be debt free, you're missing out on opportunities to buy properties today, or at least buy your first home today. So have that conversation, make sure you're very clear on what your goals are with the home buying process so you get all the right answers. And if you have questions about your scenario or not quite ready to speak to a different lender, make sure to leave a comment below in this video and I'll make sure that one of my team members answers it for you.